if you're a startup company, 50% of all startup companies pay within the first 2 years. The reason for that is lack of capital. That's the main reason. Of the 50 that survive, half of those will not make it beyond 5 years. What that means as a banker, of every 4 of you in here, only one will possibly make it beyond 5 years, become a sustainable business. So when they're looking at a loan application, how do they determine who is that one? So let me introduce our panel of experts, or at least have them introduce themselves and give a short story about what they do. I'll start with Ken.
Okay. My name is Ken Boggs, and I work for Alarian Bank. We're a local community bank based out of Ocala in Gainesville. And I've been in banking and finance for 21 years, and been in Ocala 11 years. So I'm just glad to see what we can do to help.
Karen Hatch. I work for Wells Fargo Bank. I'm a business banker. And I've been in banking for over 20 years. Been in commercial banking for over 12 of those. I'm fifth generation Marion County. And Wells Fargo has lots of lines of businesses and national. So.
I'm Anna Biglarian. I work for Center State Bank, which is headquartered in Winter Haven, Florida. It's a sizable bank with community bank mentality. Great bank. I enjoy working for them. I do commercial lending. Right out of school, right out of college, I went into commercial real estate, and about 10 years ago, I transitioned into commercial banking and been in banking ever since. And I enjoy every bit of it.
All right, so we have lenders here who are deeply rooted in your community, and I'm sure they have the best intentions for the community and you. So moving right along, first thing that I want to talk about is why do you want a loan? A lot of clients that I see who come in don't really have a good understanding of why they need money. They just come in and say they need money. So let me ask Ken if he can further expand on what information you need to be able to communicate to a lender to explain why it is that you need money.
What I'll talk about first is just personal observations that I've seen over the years and talking to customers and everything. I think the first thing that you have to understand is why do you need to borrow money? I get calls, and I'm sure everyone here gets calls, and someone will call and say I need to borrow money, and they can't really explain what it's for. And when you try to drill down and ask questions, it's like pulling teeth. So if there's really three, maybe four areas that you need to borrow money for: working capital, which is a short-term type of funding. And you really, working capital is more related to what does it take to produce another dollar plus profit. So if you take $1 and you invest that dollar into working capital, what does it take to invest that?
Past few years, as our economy started to decline, those fairly large businesses who no longer had the value that they once had were, I don't want to use the word desperate, but that would be the word, became very desperate for the liquidity. In the meantime, they had a lot of assets like equipment, fleets that were free and clear, or inventory that could have been liquidated and cash could have been generated that way, instead of approaching financial institution and taking on additional debt. Banks are very hesitant on funding, like Ken said, operating expenses. It is something that you have to generate from within, and always have the reserve to carry you through your hardships. Should we talk about ratios, or that probably is going to get
Maybe
way too
not.
Okay.
But what I would say, I'll do this as a consultant to some of you guys. This is the whole name of the game. You have a business which has assets which should be working for you to make life easier. Otherwise, go work for somebody else. These assets aren't doing anything, then your business is underperforming. But these assets are financed by debt. So if you're not growing the business either through expansion or growth, then this isn't happening, this isn't growing. So why are you going to get more debt? And at the end of the day, this has to work sufficiently good so that you can get equity. And equity is what's building value in your company. If this isn't going up, then no bank is going to touch you. Am I correct? Because then your business has no value.
And one of the ways that your equity goes up is through profit. So if you're not making, because profit, if you're making money in your business, at the end of the day, it goes directly into your equity. That's cash. So it builds your equity in your overall company. If you're not making a profit and you're coming to the bank because you're not making money, then how can the bank justify you being able to repay the debt? And that's the key in banking and in lending. You spend on this equipment. Well, over the past years, you've been able to write off every dollar of that in depreciation. Well, we can add that back. So that's a good thing.
And the reason we can add that back is that wasn't cash out of your pocket for that expense.
Yeah.
That's a non-cash expense.
So you didn't actually.
Does that make sense?
Yeah.
Okay. So when you look at your tax returns, we can add those things back. So that's one of the first things I look at when you hand me your tax returns. I'm adding things up. I'm taking the net income amount. I'm adding interest back to it. I'm looking for depreciation. I'm adding that back. I'm scrolling to the back of your tax returns and looking at your schedule of additional expenses, and I'm adding back anything on that page that I can add back. So at the end of the day, I have a number, right, that I added back and I came up to, okay? This is the income that your business made at the end of the day to be able to service, to pay back debt, okay? Then I go back and say, okay, give me your debt schedule. What are your payments? You know, you have payment on, like the lawn care diaper. You have payment on lawn care equipment, right? So at the end of the day, all the payments, the monthly payments that you pay out in a check form or however, they come up to $1,000 a month, okay? So I annualize that because this is an annual number. This is a yearly income number, right? So I annualize that and I times it by 12 months and I come up with a number, $12,000, right? So that means that I have $1 worth of debt or income to $1 worth of debt. That's all that means. It's a ratio. So it's a 1-to-1 ratio, right? I'm just breaking even.
Yeah, that's not a good ratio.
Yeah. So this is a good ratio, right? Because if you're coming to the bank and you want to borrow more money, that means you're going to have another payment, right? So if your payment is another $250, you have to have enough income. You have to have $250 a month worth of income to be able to make that payment. So if we redo our ratios, and let's say, you know, we have $10,000 here, okay? And we'll redo this ratio, and we'll say at the end of the day, we had $6,000 worth of income, or payments, okay? We had $6,000 worth of payments. Then what is that ratio? Or you know what? Let's leave this. We'll make it really easy. We had 12,000. We'll have 12, and that's for me because I don't have my calculator. Okay, so we have $12,000 worth of income, and we have $6,000 worth of payments.
That's his niche. That's what he does. And is there available avenues of financing for you? Absolutely. You just have to know how to look for them.
And they're not, and obviously they're probably not going to be And
In traditional banking.
Yeah, I
Yeah.
can't speak for Anna's bank, that it's not gonna be at your Wells Fargo banks or your,
And it won't be at ours. If you call me, we would have had this conversation. Now, I will talk to you and say, here's what you need to do, but then the next conversation, I'm gonna say, you need to call Mike, and he's gonna refer you to Fred Kritzman.
And just to add to that, it's not going to be in any conventional banking environment. But don't let that scare you off. I just want to explain why conventional banker would not be chasing that particular type of credit. For one thing, it is unlikely that it will be collateralized. So we're dealing with unsecured loan. In addition to that, it's a startup, and what you just mentioned, yes, there are statistics that we can refer to, there is industry data that we can refer to, but there is no historical data. So unless you have personally financial capacity to carry that obligation without depending on the income that you derive from that business, and you have or you have someone who has substantial financial strength and liquidity, not only hard assets and paid off.